Further, it is related to strategies for controlling the interest rate risk. Strategies for controlling the interest rate risk. The actual management of the bank's asset liabilities focus on controlling the gap between the rate sensitive assets and rate sensitive liabilities. So what we are going to do, actually, we are going to basically bridge up the gap between the risk sensitive assets and risk sensitive liabilities. So we want the minimum gap between the risk sensitive assets and risk sensitive liabilities. That is the first strategy. And also some banks do follow the strategy of matching the assets and liabilities maturities as closely as possible. They do not just look at the RSAs and RSLs, they also look at the factor of the residual maturity. They try to match the residual maturity of the risk sensitive assets and liabilities so as to reduce the gap to zero and further insulate the NII from the volatility of the interest rate risk. Because if you are having the reduced gap, if the RSA are almost equal to the RSL, in that particular case you will be basically you can basically maintain your net interest income. Still there will be the volatility, but you can minimize the volatility. So aggressive banks vary the gap in tune with their interest rate forecast. So aggressive banks do what? They do forecast the interest rate, and as per that they do vary their interest rate gaps over there, risk sensitive assets liabilities gaps over there. If they predict or if they expect interest rate should increase, if they expect that the interest rate will be increasing, they will be widening the gap by repricing the assets more frequently than their liabilities. What does it indicate? Because they want to earn the profit out of the market situations. So if they are expecting that the interest rate will be rising in the market itself, in that particular case they will be frequently repricing their assets over there. It means what? It means that they will be having more risk sensitive assets in the times to come, and in that particular case they will be earning more on their assets, and further they will be paying lesser on their liabilities. Let us take the case that previously you were having 100 crore rupees in your assets and 100 crore rupees in your liabilities, that you are having zero gap. If the interest rate rises, in that particular case you will be the interest will be, if we say that the interest rate is increasing by the same magnitude, if we are basically assuming that if the interest rate is increasing by the same magnitude, in that case if the interest rate increased by 1% on the asset side and the increase by 1% on the liability side, you will be earning the same amount. But the aggressive banks will be doing what? Aggressive banks will be doing the repricing of the assets more frequently, so that you are having more risk sensitive assets. What does it indicate? Now your risk sensitive assets is equal to 110. Okay, now if the interest rates are rising, in that case you will be earning more on these assets, and further you will be paying lesser on these assets, and definitely you will be earning the profit out of the situation. That is related to the market exploitation. Okay, and further that is related to the strategy for reducing the assets and liability sensitivity. What is the strategy for reducing the assets and liability sensitivity? So as to reduce the asset sensitivity, extend investment portfolio maturities. If we want to reduce the asset sensitivity, what does it indicate? That we do not want the assets so as to reprice in a short term period. So okay, that is related to it. In that particular case you need to extend what? You need to extend the investment portfolio maturities, where we were receiving the investments, where we were investing into those scenarios, those securities where the maturity was in 1 month or 2 months. Now we will be investing in those securities which are having longer maturity periods. Okay, and further increase floating rate deposits, because you want to decrease your risk sensitive liabilities. If you are having the more floating rate deposits, if you're having the more interest rate floating rate deposit, in that particular case that's related to the liability. You want to increase the liability, and further that is related to what? That is related to your effect of the risk sensitive asset will be decreased. Because let's take the case that in the case that you are having the risk sensitive assets at 100 crore, and further if you increase the risk sensitive liability of the volatile liabilities at 120 crore, which was previously 80 crore, and further you want to decrease the impact of the risk sensitive assets, you will be increasing the risk sensitive liabilities in that particular time period. That is related to it. And further increase fixed rate lending, that the term loan that you were sanctioning. Let us take the case, if you were sanctioning for 3 to 4 years, now you'll be sanctioning for 7 years or 8 years, or for the longer period, so that you can decrease the risk sensitivity. And for the self-floating rate loans, that is also criteria by which you can reduce the risk sensitivity. Further increasing the short-term borrowings, increase the long-term lendings, that is also related to reducing the asset sensitivity. Then it is related to the reduce liability sensitivity, reducing investment portfolio maturities. Reducing the investment portfolio maturities. Now we want to do what? We want to reduce the liability sensitivity. So if we reduce the investment portfolio maturities, in that particular case, whatsoever the amount that you have invested, that will be basically maturing soon, and further that will be setting off the risk sensitive liabilities. Okay, and further increasing floating rate lending. If you increase the floating rate lending, in that case also the effect of your risk sensitivity liabilities will reduce. And increasing the long term deposit is basically itself increasing the risk sensitive, it is basically increasing the residual maturity of the liabilities. As per that will be reducing the liability sensitivity. And further increasing short term lending will also be setting off with the effect of the risk sensitive liabilities. Is that clear? So that can be done. And now let us have a look at the basic balance sheet strategy. That is related to the basic balance sheet strategy. So basic balance sheet strategy to alter banks' interest rate exposure is to effect changes in the portfolio composition. So we want to make changes to our portfolio composition so as to basically any variation in portfolio potentially alters a net interest income. So we must be following some strategy by which we can set off the negative effect and further can maintain our net interest income. Okay, so the liability sensitivity situation can be tackled. By pricing more loans on floating rates. So basically, if you want to contain the liability sensitivity situation, let us take the case that you are having the RSA amounting 80 crore and RSL at 120 crore. That is for the 1 to 3 years period. Okay. Under the time bucket of 1 to 3 years, you are having the risk sensitive assets at 80 crores and risk sensitive liabilities at 120 crores. So there is a negative gap of 40 crore. Over here. And if you want to reduce the impact of the risk sensitive liability, in that case, either you can do what? Either you can decrease those liabilities, okay, or you can do what? Or you can increase the risk sensitive assets in that particular time bracket. That you can do now. So that can be tackled by basically pricing more loans on floating rate basis. Okay, so we will be pricing more loans on floating rate basis so that they will be falling under the risk sensitive asset criteria, and ultimately your RSA will increase. Is that clear? Or shortening the maturities of investment securities, that we have already covered, that if you shorten the maturities, in that case also your risk sensitive liabilities under that particular time bucket, those will be reducing. Is that clear? Further, the banks can also consider selling fixed income securities. The bank can sell those securities and reinvest the proceeds in securities with the short term maturity. So we will be reinvesting into the short term maturity, which will basically alter what? Which will be basically increasing the RSL for the shorter term period, which will be basically increasing the risk sensitive assets, which will be basically increasing the not risk RSL, it will be increasing the RSA for the short term asset. Okay, so let us take the case that where you were going to receive the maturity after 3 years. Now you basically sold that particular security and you invested into the security where you will be having the monthly repayments. Now that is basically increasing what? That is basically increasing the RSA over the shorter time band. Is that clear? The other options which are available with the bank, so as for managing the interest rate risk, that is related to match long-term assets preferably with the non-interest bearing liabilities. So we will be matching the long-term assets with the non-interest bearing liabilities like current assets. Okay. And for the match repriceable assets with the similar repriceable liabilities, so that there is no gap between the RSAs and RSL. Okay. Third is related to that we can use a forward rate agreement or swaps or options or and financial futures to construct synthetic securities. So we can build up the synthetic securities so as to hedge against any of the differences against the interest rate risk over there. And maturity mismatch is accentuated by proliferation of non-performing assets. So the mismatch is basically the mismatch increases. The maturity mismatch increases if there is increase in the non-performing assets. If there is increase in the non-performing asset, or if you restructure the loan, in those particular cases, your maturity mismatch will increase. Your maturity mismatch will increase, and that will basically expose the bank to the interest rate risk. Okay. So large volume of NPA in the balance sheet entail carrying of non-interest earning assets and funded out of the volatile liabilities. Okay. So what does it indicate? It indicates that if your NPAs are increasing, if your non-performing assets are increasing, so basically the amount that was expected to be received, that you will be not receiving. So that will be basically non-interest earning assets. Those NPAs are basically non-interest earning assets where you will not be earning the assets, and further the provision for the same is to be made out of the volatile liabilities, and for that particular purpose the volatile liabilities are to be created and you'll be making the provisions out of this. Okay. So that is related to it. And further it is related to the adverse impact on NII due to mismatches can be minimized by fixing appropriate tolerance limits. So we must be having the appropriate tolerance limits on the interest rate sensitivity gaps. On the interest rate sensitivity gaps, whether for the period of the 1 day or 2 to 7 days or 8 to 15 days, 16 to 28 days, in all those cases we must be maintaining the appropriate interest rate sensitivity gaps, so that a tolerate limit is there, and further your gaps should not go beyond those particular limits. Okay. That particular way you can manage the interest rate risk for the shorter term period and also for the longer term period. So the banks should also evolve suitable in-house expertise for forecasting of the interest rates, because that is the particular criteria. If you know that what would be the market trends related to the interest rate, you can definitely plan something. You can plan your strategy related to that. You can manage your risk sensitive assets and liabilities for that particular time bracket, and further can overcome from the interest rate risk. Is that clear?